What's up, everyone? Welcome back to OG John XX. I hope you're doing well. I hope your portfolio is holding up. And I genuinely hope you're paying attention right now, because what I'm about to walk you through is not a regular market update. This is the kind of video that years from now, you'll look back on and say, I heard this, I understood this, I acted on it. Or you'll look back and wish you had. So stay with me until the very end. Because right now, on 1 March 2026, we are sitting at the simultaneous convergence of geopolitical escalation, exchange-level delivery stress, physical supply collapse, and a war that just redrew the entire map. Whew, this is not noise. Subscribe to the channel, hit the bell, drop a like, and let's get into exactly what is happening. Let's start with where silver actually stands right now, with real numbers, not estimates. As of Friday, 27 February, silver closed at $92 per ounce. On Saturday, 28 February, as news of US and Israeli strikes on Iran broke, spot silver immediately surged to $94.50 per ounce. India's physical market confirmed this directly. Silver in Mumbai jumped 10,000 rupees per kilogram in a single session, the biggest single-day move in weeks, driven purely by geopolitical safe haven demand overwhelming all other price inputs. As of today, Sunday, 1st March 2026, global markets are closed for the weekend. But when they open Monday, the structural pressure that has been compressing into this market from multiple directions simultaneously is going to find its release valve. And that release is not going to be quiet. Now, to understand what Monday looks like, you need to understand the journey that brought silver to this exact point. Because this is not a simple story. This is a multi-chapter story, with each chapter making the next one more explosive. Chapter 1, January 2026. Silver does something it has never done in its entire recorded history. It breaks $100 per ounce, a psychological level that entire generations of precious metals investors had debated as a theoretical ceiling. Silver did not just touch it, it accelerated through it. By January 29th, silver hit an all-time nominal high of $121.88 per ounce, a 68% gain in a single month, silver's strongest monthly performance since December 1979. This was not speculation in isolation. This was the intersection of 6 consecutive years of structural supply deficit, explosive industrial demand from solar, EVs, 5G, AI hardware, and a global tariff-driven panic that sent institutional capital flooding into hard assets simultaneously. Then, Chapter 2 arrived. On January 29th, the same day silver printed its all-time high, the CME Group triggered what can only be described as a controlled demolition. Margin requirements for silver futures were hiked to 15% of notional value, forcing leveraged traders to either inject capital immediately or liquidate. The liquidation cascade was violent. Silver crashed from $121 to $63.85 by February 6th, a 47% collapse in 8 trading days. One of the most devastating single-asset drawdowns in modern commodity history. U.S. Treasury Secretary Bessent publicly attributed the extreme volatility to Chinese speculative positioning, though analysts were quick to point out that the CME's own margin mechanics were the mechanical trigger that amplified every dollar of selling into 5. When an exchange begins enforcing limits aggressively, it signals volatility risk, position concentration, liquidity imbalance, and potential delivery stress compressing into the same window. That is exactly what happened here. But here's what the mainstream narrative missed entirely. The crash did not resolve the physical supply problem. It made it worse. Chapter 3. And this is the chapter that changes everything about what comes next. Comex registered silver inventory, the metal actually available for physical delivery against futures contracts, has been in free fall for 5 years. From 346 million ounces in 2020 It has collapsed to approximately 88 to 98 million ounces today. That is a drawdown of roughly 75%. And here is the critical number that every serious investor needs to understand right now. As of 27 February, the first notice day for March contracts, open interest in March silver futures represents approximately 400 to 430 million ounces of notional delivery obligations, against a registered inventory of under 100 million ounces. That is a coverage ratio of less than 25%. If even 25 to 30% of March contract holders demand physical delivery instead of rolling or settling for cash, the math breaks. Comex does not have the metal. Withdrawals from registered inventory have been averaging 785,000 ounces per day, and metal is leaving the vault, not entering it. The market is in backwardation, meaning spot prices are higher than futures prices, which is not normal, and which signals that buyers are willing to pay a premium for silver today, right now, rather than wait for future delivery. That is the physical market screaming that supply is structurally unavailable. The Silver Institute confirmed this in their February 10th report, projecting a sixth consecutive year of supply deficit for the silver market in 2026. 6 years, consecutive, not a cycle, a structural collapse in the supply-demand equation. And then, into this already critically stressed physical market, on 28 February 2026, a geopolitical earthquake arrived. U.S. and Israeli forces launched coordinated military strikes on Iran's nuclear and advanced military infrastructure. This is not a proxy engagement. This is not a limited strike package with a defined exit. This is a direct, superpower-level military confrontation, the scale and strategic implications of which place it categorically above anything the Middle East has produced in recent decades. Iran has responded. Counterstrikes have been initiated across the Gulf region. Bahrain, Kuwait, Qatar, UAE, all operating under elevated military alert protocols. Naval activity around the Strait of Hormuz has escalated dramatically. And it is the Strait of Hormuz that connects the geopolitical event directly, mechanically, to what happens to silver on Monday morning. So let's break down the transmission mechanisms, precisely, not emotionally. The first mechanism is safe haven capital rotation, and this time, it is not incremental. When geopolitical risk breaches a threshold of this magnitude, institutional capital does not deliberate. It moves, fast. It exits equities, high-yield credit, emerging market exposure, and it concentrates into hard, liquid, historically proven stores of value. We have already seen the first signal. Silver's 8% single-session gain on Saturday, as news broke, is the opening tremor, not the earthquake itself. Markets were closed for the weekend. Monday is when full institutional flow engages. The safe haven bid that builds from here is operating at a scale that the Russia-Ukraine event in 2022 and the Hamas-Israel event in 2023 did not approach, because neither of those involved the United States as a primary military actor. This one does. The second mechanism is the oil inflation transmission channel. Iran controls the Strait of Hormuz, the single most critical maritime choke point in global energy logistics. Approximately 20% of global daily oil supply transits through this passage. Any meaningful disruption, even partial, sends crude into a vertical repricing. Analysts running disruption scenarios are modeling immediate targets of $120 to $140 per barrel. When energy reprices at that velocity, inflation does not drift higher. It jumps. And when inflation jumps, capital does not wait for central bank guidance. It moves directly into hard assets, silver, gold, real stores of value. Because paper currency is losing purchasing power in real time, and every informed participant knows it. The third mechanism is dollar debasement pressure. Large-scale military operations expand the U.S. fiscal deficit rapidly and visibly. They raise questions about the long-term credibility of the dollar as the global reserve currency. Silver, priced in dollars, rises inversely. This is not theory. It is the historically documented mathematical relationship between dollar weakness and silver repricing. The conditions for that dynamic are not just forming, they are already in motion. The fourth mechanism, and this is the one that most people are not tracking, is the Comex delivery event. When an exchange environment begins enforcing limits aggressively, when margin requirements are already at historic highs, when registered inventory is already critically depleted, and when a geopolitical shock simultaneously drives safe haven demand into the same physical market, what you get is not a smooth price adjustment. What you get is a non-linear event. March is Comex's primary delivery month. 400 million ounces of notional open interest against under 100 million ounces of registered physical metal. Metal leaving the vault at 785,000 ounces per day. Backwardation confirmed. And now, a geopolitical catalyst driving incremental physical demand from institutional safe haven buyers who want metal, not paper promises. If delivery demand in March breaches the threshold of available registered inventory, the resulting price event will be unlike anything most market participants have modeled. Bank of America's metals research head has a 2026 price target of $135 to $309 per ounce, depending on gold-silver ratio compression. Coin Codex algorithms project silver reaching $99 within the next 7 days. Whether those specific numbers materialize is not the point. The direction and the magnitude of what is now compressing into this market is the point. Now, and this matters, both directions must be accounted for. Geopolitical events are the most volatile and unpredictable inputs a market can receive. A ceasefire announcement, an unexpected diplomatic intervention, a de-escalation signal. Any of these can reverse a silver move as fast as it was generated. If you are trading this short term, stop losses are not optional. They are structural requirements. If you are operating with leverage, understand that the CME has already demonstrated once this year that it will hike margins without warning and without mercy. Leverage amplifies losses with the same mathematical precision it amplifies gains. Respect the instrument. And if you are a long-term investor, understand that volatility in a market with 6 consecutive years of structural supply deficit, depleted exchange inventory, compounding industrial demand, and geopolitical escalation is not your enemy. It is your entry point. Every flush of weak hands is an accumulation window for informed capital. The structural case for silver in 2026 is not intact, despite what has happened. It is more intact because of it. Supply is critically depleted. Industrial demand is compounding. Inflation has not been durably defeated. The Comex delivery clock is ticking toward a March reckoning. And now, geopolitical risk has activated the safe haven, inflation hedge, and dollar debasement arguments simultaneously in the same market window. Short-term price action will remain volatile. Medium and long-term, the direction is unambiguous. Here is where we stand as of 1 March 2026. Silver closed at $92 Friday, surged to $94.50 Saturday on geopolitical news, and is entering Monday with a depleted physical supply structure, a Comex delivery event in March, a war in the Middle East directly threatening global oil logistics, and institutional capital positioned to rotate into hard assets at scale. $95 to $100 is the immediate technical target. If delivery stress and geopolitical panic converge in the same window, 105 to 110 is not aggressive. It is the mechanics playing out as designed. Stay informed, stay disciplined, and stay positioned correctly. If this breakdown gave you clarity, like the video, share it with someone who needs to hear it. And subscribe to OG John XX so you never miss a critical update like this one. Take care of yourselves and stay sharp.